Hier geht es jetzt weiter in Englisch mit Gold Royalty. Das Unternehmen, wie der Name schon sagt, beschäftigt sich mit Gold und hat ein Portfolio an Royalties und präsentieren wird David Garofalo. Vielen Dank.
Good morning. Thank you very much for attending our presentation today. And I've heard some very compelling presentations over the course of the last couple of days about the fundamentals for gold, and hopefully you'll indulge me for a few minutes talking about gold's fundamentals from a miner's perspective. I've been in the industry for 35 years. Most recently, before I founded Gold Royalty with Amir Adnani 3.5 years ago, I ran Goldcorp and merged it with Newmont in 2019. Ran Hudbay Minerals in the copper business for 6 years and was the CFO of Agnico-Eagle for a dozen years. So I've been involved in the construction of 15 mines over my career, run countless more operations within the portfolios of each of those companies. And what I would say about gold fundamentals, which I think provides valuable context for Gold Royalty and our business model, is that gold has never been in a better position to provide all-time highs against all the major currencies globally. And the fundamentals that are driving gold are the same types of fundamentals we saw back in the 1970s when we last had a major inflationary cycle. We saw a massive expansion of money supply. And in fact, if you look at gold over the last 50 years, it's really been a one-way trade. It's gone from $35 an ounce when the US government abandoned the gold standard in the early 1970s to over $2,800 an ounce today. And over that time, the purchasing power of all the major currencies globally in the Western world have gone down about 96, 97%. When fiat currencies become untethered from any physical backing, fiat currencies can only do one thing. They can only depreciate in value because the temptation for governments to expand money supply is immense, particularly in this environment today where we find debt levels at all-time highs. Back in the 1970s, when we had a big inflation cycle, global debt to GDP was only 100%. So as you can imagine, when Paul Volcker came in to run the Federal Reserve, he had the latitude to raise interest rates dramatically to tame inflation. And we experienced a peace dividend over 20 years of virtually zero inflation as a result of his efforts. He brought interest rates to 20%. Headline inflation back then was around 14, 15%. And he brought inflation down to 0 to 2% for a 20-year period. Today, global debt to GDP has reached 350%. So as you can imagine, central banks globally have very limited latitude to raise interest rates in order to tame inflation because it would bankrupt governments. In the US, for example, debt service has doubled over the last 18 months to $1 trillion per year. And as treasuries are refinanced over the course of the next 18 months, no matter what happens to nominal interest rates, debt service in the U.S. will double again to $2 trillion. To provide you some perspective, that's 2 out of every $7 of tax revenue generated in the U.S. That's simply unsustainable. So the only way for central banks and for governments globally to deal with this pile of debt is to inflate it away. And I think we all appreciate that inflation that's reported globally, the headline numbers, vastly understate the reality on the ground. Nobody here is experiencing single-digit inflation. If you're putting food in your stomach, fuel in your car, or you're putting a roof over your head, you're experiencing double-digit inflation. What that means is that real interest rates are in negative territory. That's what's driving this flow of capital into gold. And that's why we've seen gold prices achieve all-time highs on a nominal basis. We still have not achieved all-time highs for gold on a real basis. If you look at the peak gold price back in the early 1980s and inflation adjusted to 2024 dollars, that would be well over $2,800 an ounce. But back then, again, debt levels were much more manageable and sustainable, and they are today. So that means that gold is likely to go much higher because it is an accurate barometer of real inflation. And real inflation is much, much higher than the central banks would like you to believe. And so we're going to see a continued devaluation of fiat currencies in order to devalue the debt that these governments are currently trying to service and are unable to service in a fiscally responsible manner. So if you buy into gold as an asset class, the question you have to ask yourself as an investor is, where are you best placed to get optimum leverage to that gold price? And it's not in the producer universe, unfortunately. I've spent my entire career building and operating mines, and I can tell you the reason I'm running a royalty company today is because the industry is shrinking. Global reserves in the ground have gone down 40% over the last 12 years. In other words, the mining industry continues to shrink because they have not reinvested money into exploration to replace depleting reserves. The juniors in our sector, as you well know, have not had access to capital for a dozen years, and they are the ones that do all of the heavy lifting on exploration. They're the ones that make the major discoveries, and because they have not accessed the equity markets for a dozen years, there have been no significant discoveries in our industry. So not only do we look at gold as a currency, and the fundamentals are absolutely profoundly strong for it, but when you look at the supply dynamic in our industry, it's continuing to shrink, and so there's a supply squeeze from a miner's perspective. And also, the producers are not only facing declining reserves, but they're also facing significant inflation in their input costs, capital and operating costs. So their margins are not expanding. That's why we're not seeing the gold equities on the producer side perform as we expect them to perform. Gold's up 30% this year. The bigger producers in the world are only up 30%. In other words, they performed exactly in line with the commodity, but they should be offering you leverage to the commodity price. They should be vastly outperforming the commodity, but they're not doing that because their reserves are shrinking and their operating costs are going up. So the place to get optimum leverage to the gold price is in the royalty universe, where you get a percentage of the gross revenue, and you're completely protected from inflation at the mine site. In addition, you get the leverage to the exploration upside of the operators of the mines that we have royalties on. So as they conduct exploration, we don't contribute to their exploration budgets, but we get the benefit of that upside because our royalties run with the mine. And so again, optimum leverage to the gold price with complete protection from inflation and leverage to exploration. That's where you're going to get outsized returns relative to the commodity. And that's why I've co-founded a royalty company after 35 years of building and operating mines. I believe in gold as an asset class, but I'm not comfortable that the producers in our universe can offer you leverage to the commodity price, but a royalty company can. And over the last 3.5 years since we founded the company, we've grown from 18 royalties to over 240 royalties. And this year, after starting up the business 3.5 years ago, we're actually in the free cash flow territory. We're in an inflection point as many of our operating mines come into production and our revenue expands exponentially over the course of the next 5 years and our free cash flow grows dramatically. So we're not only in a business that's optimally leveraged to the gold price, but we're in a business, regardless of what happens to the gold price, we'll see significant volume growth in terms of the attributable ounces we're getting from the mines that we have royalties on. And we're getting the full benefit of the upside in the gold price that we're likely to receive as an industry over the course of the next several years as fiat currencies continue to be depreciated and gold price continues to go up. And the reason we've been able to grow the business so quickly and so dramatically is because many of the people within my executive suite and on my board have similar experience levels to me. We only have 8 full-time equivalent employees. We have 6 directors, but collectively over 400 years of industry experience. So many of us have come from an operating and mine development background, and that gives us 2 distinct advantages. One, it gives us a clear-eyed view of the underlying risk of what we're investing in. So when we put capital to work with a mine and take a royalty back in return, because we were developers and operators ourselves, we understand the intrinsic risk and we can price it appropriately to make sure that our shareholders get maximum rate of return. The other thing that it offers us with 400 years of collective industry experience is access to anybody in the mining industry that we want to do business with. It means that we get access to royalty opportunities before many of our competitors are even aware of them. That's why we've grown the business so quickly. We've increased the number of our royalties 15-fold in 3.5 years, and we're going to see 60% compounded annual growth in our revenue over the next 5 years as we deliver this production growth that we've already bought and paid for. And the other attractive feature of our model is every single one of our 240 plus royalties are bought and paid for. We have no capital calls. All we have to do is sit back and harvest the returns on the mines that our operating partners are building, exploring, and expanding and optimizing. So this gives you an overview of how we've grown that portfolio. We started with 18 royalties in our IPO in early 2021, and through a series of acquisitions of other royalty companies, we added over 150 royalties over the course of 2021 as we took over 3 companies. And then we've grown through other means such as project financing, where we provide capital to the operators to expand and explore and develop their mines. We acquired third-party royalties from prospectors who were looking to monetize the royalties on the properties they staked. And we also grow through our organic royalty generator model. In other words, we stake exploration claims around existing mines, and then when the neighbor knocks on the door and says, I need that piece of property because our deposit trends into it, we sell them the property and take a royalty back in return. And about a third of the royalties that we own, we generated that way through our sweat equity. So even if one of them generates a significant royalty, our rate of return is infinite because our cost of entry is effectively zero on those organic royalties that we've generated internally. So we have a high rate of return business because we've grown through 4 distinct pillars, which is a unique feature of our royalty company relative to our peers. Many of the royalty companies grow through 1 or 2 or maybe even 3 of those pillars, but we grow through all 4. And again, even among the larger cap players in our space, we're unique in that regard. So these are the 4 pillars I was talking about. Again, M&A, when we have the currency in order to transact, we rolled up some of our competitors. We've done project financings. We've done third-party royalty acquisition. And I think importantly, we generated 2 to 3 royalties per quarter through our organic royalty generator model, again, through our staking and farming out process that generates royalties effectively for free. And this just gives you an overview of our revenue growth in the current year. We're looking at nearly a tripling in our revenue as a number of our late-stage development projects come into production, namely Cote in Canada, IAMGOLD's newest mine, Varus, where we acquired a copper stream in Bosnia. Adriatic Metals has brought that mine into production this year. And also Canadian Malartic, the largest producing gold mine in Canada, is generating increasing revenues and cash flow from its underground operation as it completes a $1.6 billion expansion by my old company, Agnico-Eagle, that's the operator of that mine. Over the long run, again, over a 5-year period, and these are consensus estimates, we have 6 analysts that cover us, we're seeing a 60% compounded annual growth in the attributable ounces, and that's the bar in this chart, the yellow bar, over the course of the next 5 years. When you apply the gold price to that, and then you can pick the gold price you want. These lines represent our revenue at various gold prices. At current gold prices, we're going to see our revenue approach $80 million by the end of the decade, up from $5 million last year. So again, exponential growth, and this is against a cost structure of only $7 million per year. We have 8 full-time equivalent employees, and I can assure you we could run a business with 2,400 royalties with the same number of employees. It's the scalability of this business that makes it so attractive. Every incremental dollar of revenue goes right to the bottom line and generates an incremental dollar of free cash flow. It puts us in an excellent position to start to return capital to shareholders by the end of next year. So it's a remarkable process that we've undergone. We started up with no revenue and only 18 royalties in 2021. Today we have over 240 royalties. We have exponential growth in our revenue. We have free cash flow generation. As you can see, our generation and free cash flow increases dramatically over the course of the next 5 years as many of these large-scale mines come into full-scale production by the end of the decade. And this is a value play right now. We're trading on a consensus basis at less than half of NAV. Why are we trading so discounted given the quality of our portfolio? Is because we have the most significant growth, and growth has been severely discounted in our industry. But the re-rate potential is significant as we crystallize that growth. And that growth is not a far-off proposition anymore. We're right in the midst of it. This year, we're seeing our revenue effectively triple. And again, we're seeing 60% compounded annual growth each and every year right through the end of the decade. And we are right in the middle of it, which means that re-rate opportunity is significant near term. Even if we get to the median of our small cap peers, we would see at least a doubling in our share price. If we got up to the kind of multiple that the senior royalty companies have already achieved, then we could see a 4 or 5-fold increase in our share price, absent any increase in the gold price. Again, it's just based on volume growth from the many large-scale royalties that we have within our portfolio. And this gives you an overview of our pipeline. We have 7 cash-flowing royalties. We have another 14 in various stages of construction and development that underpins that significant revenue growth. And then we have significant optionality within the advanced exploration and exploration stage royalties that provide us upside from an exploration perspective. Again, All of these royalties are completely bought and paid for. We never have to put another dime into them. All of our operating partners are conducting the development, the exploration, the expansions on their capital budgets. So we never have to put another dollar in them to realize that significant growth that we talked about a little earlier in the presentation. And as you can see, we have over 80 operating partners within our portfolio, and all the biggest gold producers in the world are our operating partners, which means that our operating partners that own the underlying mines that we have royalties on have both the balance sheet capacity and the technical strength to grow and optimize their operations. So some significant catalysts this year that are driving the revenue growth. As I said, we're looking at nearly a tripling in our revenue this year, driven by some of the biggest operating mines in North America and beyond. And this year in particular, Côté, which will represent Canada's second biggest producing gold mine, came into production. As it ramps up, our revenue is ramping up from that. We have a new copper stream from Varus, Adriatic Metals' newest mine in Bosnia. We also have increasing revenue and cash flow from Canadian Malartic, which has been Canada's biggest producing gold mine for over a dozen years. So a very solid portfolio of operating mines with a heavy concentration in the Americas. In fact, we have royalties on 3 of the 5 biggest producing gold mines in North America. On Canadian Malartic, Agnico-Eagle's mine in Quebec. On Côté, IAMGOLD's mine in Ontario. And also on the underground extension of Goldstrike, which is the biggest producing gold mine in North America, owned by Barrick and Newmont in Nevada. So not only do we have a diversified portfolio, but we have one concentrated on some of the biggest, largest scale, longest life deposits to provide us a foundational element to our story. So I can see that we're running out of time. With that, I'd like to welcome any questions that you might have.
Thank you. Seems to Mike, yes. Thank you very much. David Garofalo, Gold Royalty.